We call REOCs, or real estate operating companies. They're companies that essentially do the same thing as REITs, or real estate investment trusts. The difference being a REIT is required to pay out, and each country is a little bit different, but in the US, for example, the REITs are required to pay out 90% of their taxable income to shareholders in the form of dividends. And what that means is there's not a lot of cash flow left over at the end of the day for those companies to do new acquisitions or new developments, so they constantly have to go back to the capital markets and raise capital to grow their business. A REOC, or a real estate operating company, simply chooses to be a taxable entity, and they're able to retain all of their cash flow if they choose, but they're able to reinvest that cash flow. And the view that capital in real estate is very precious, and real estate is a very capital-intensive business. So the ability to retain capital and not have to go out and seek capital when oftentimes it's not available gives the real estate operating companies a distinct advantage long-term. Most REITs tend to accumulate assets by buying them, and they tend to pay whatever the market price is for those assets. And the idea is to buy assets at a yield and create a spread over their cost of debt and equity capital. And that works great. You create a spread and you pay dividends. The real estate operating companies tend to be more involved in the development and creation of value. So what I've often said is that REITs tend to be collectors of assets, where real estate operating companies tend to be creators of value.